Hi, welcome back to our class. In this video, we will continue our discussion of equity capital market financing by looking more at initial public offering, or IPO. Before a firm gets to the IPO stage, the advantages and disadvantages of going public need to be considered. An obvious advantage of going public is that firms need capital financing in order to grow. For example, during the times of Industrial Revolution, family businesses grew to the stage that their financing needs could not be provided by a few individuals. Another important advantage of becoming a public firm is the liquidity of company stocks. Private equity of firms lacks liquidity and efficient pricing. For example, if you are a private owner of a company, you may find it difficult and time-consuming to find a buyer of your company shares. And it also takes effort to reach an agreement about the pricing of private shares. But the shares of a public company are a security that is ready to be bought and sold in a stock exchange. The need for liquidity is the apparent reason for Spotify, a music streaming company, to go public in April 2018. Spotify did not seek to raise money. The listing of Spotify was recognized as a direct listing, which means instead of issuing new shares, the company started trading by letting existing shareholders directly trade their shares on the public market. In a direct listing, there are no underwriters to buy and sell new shares. Investment banks act as financial advisors to guide the process. The increased liquidity of company shares brings another advantage to public firms, where these companies can use company shares to pay for mergers and acquisitions. So going public creates a new currency for companies to grow. This is particularly important for high-tech companies with high growth potentials. Other advantages of going public include enhanced public image and brand recognition. While we have talked about the many advantages of going public also comes at cost. The first disadvantage is the upfront cost of an IPO. The fees of an IPO may amount to 8% of the proceeds raised for smaller deals. In Alibaba IPO, the fees to investment bankers amount to a total of $300 million. Another disadvantage facing public companies is the time and money spent preparing for periodic reports to the public. As required by security laws, public firms are subject to constant disclosures of financial and other significant information to the public. Public information can be useful for competitors as well. The need to do short-term reporting may also distort with long-term corporate growth. For example, a company may have business opportunities that can benefit a company in the long run, but may reduce net profits for the current financial year. Last but not least, public firms are also subject to the threat of hostile takeovers because its shares are open to be bought on the market. After reviewing the many advantages and disadvantages of going public, if a firm finally decides to go public, in the next step, the firm needs to hire investment banks as underwriters and start the IPO process. An IPO process starts with appointing the underwriters. An IPO is often underwritten by several investment banks called an underwriter syndicate. The leading underwriter in charge of an IPO process is called a lead bookrunner. Other investment banks who mainly help with the selling of stocks are called co-managers. The ECM division will help an issuer to decide details of the issue, including pricing range, offering size, and deal structures. The investment banks start the process with due diligence investigations. The practice of due diligence originates from Securities Act of 1933, which managed the liability sharing between issuers and investment banks for inaccurate information disclosures. This extremely high level of liability exposure drives investment bankers to conduct due diligence to mitigate risks. In the due diligence step, investment banks will need to have a full understanding of the businesses of the company. The purpose is to make sure information disclosed in the registration statement is complete and accurate. At the same time of due diligence, investment banks will start to draft a prospectus. This process may take around 2 months or longer. When a preliminary prospectus is ready, the issuer can file for registration with SEC. This prospectus will then be revised in following weeks according to feedbacks of SEC. At the same time, the trading division will gather analysts to prepare research reports and have meetings with its sales force. After these works are done, the underwriters will start preparing marketing to institutional investors. Next, the issuing firm and the underwriters will start its roadshow to officially promote the securities to be offered to its potential investors. A roadshow provides important information regarding the pricing of an IPO through a process called book building. The issuing price will be decided after book building. The issuing price will be added to the final version of a prospectus. After the final registration is declared effective by SEC, the underwriters can start selling securities to investors, and the issuing company will be listed on a stock exchange. Okay, in this video, we have provided an overview of IPO process. Thanks for watching, and in the next video, we will discuss IPO pricing techniques.